welcome to Galaxy Brains, the weekly podcast from Galaxy Research. I'm immersed in the verse and the coins that I join when I purchase. No, I furnish into purses. No, my person is purpose, cause my passion is worth it. I earn it. Never feeling like I got another life to live, cause I got plenty to give, so long as the planet still spins. Damn, it's been panic, insanity managed, humanity manic, vanity demands vigilance. Yo, the ink, I've been spilling it, every beat, I've been killing it. Our guest this week is top billing Tyler Williams. Even on vacation, no one is filling in. I'll be rapping in my grave when the shovels start filling it. In all seriousness, the game is never ending. There's always something pending and always needs defending, but I am always sending, and you know I'm not pretending when I tell you I'm contending that we're winning in the ending. As always, I'm your host, Alex Thorne, head of firm-wide research at Galaxy Digital. Thank you for listening to Galaxy Brains. We have a great show for you today. As I said, we are talking with Tyler Williams, head of public policy at Galaxy Digital, about the ongoings in Washington, both generally and in crypto. And of course, we'll check in with our good friend Beimnet Abebe to talk markets and macro. But before we get to all of that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information contained in this podcast represents investment advice or an offer, recommendation, or solicitation by Galaxy Digital or any of its affiliates to buy or sell any securities. Getting fast at that, Finn. I don't know, we're going to need to... It's not sped up. Hey, I'm in here on vacation for y'all. I never miss a Galaxy Brains. We've got a great one for you, so let's get right into it. Let's go now to our friend Beimnet Abebe from Galaxy Trading, as always. How are you, my friend? Good to see you.
Doing well. Nice to see you, too. I know you're on vacation. So
technically, I'm not here. I was in the office. I'm in the office because I'm on vacation in New York. And someone was like, oh, Alex, about that thing. I was like, no. I'm not here.
Yep.
Don't talk to me. But I will talk to you, my friend, because it's been exciting in markets.
Absolutely.
To point out, last week on our show, you said that gold was going higher. It has. We're through 2,000.
Yep.
You talked about the incredible technical setup for Bitcoin. It was higher on the monthly, the weekly. The daily chart looked good. We closed the quarter, 3 consecutive up months.
Correct. And an outside month to boot.
But I will say, just in the couple of days since then, Bitcoin holding in the 28K range. But a big geopolitical maneuver here. OPEC unexpectedly cutting production, and oil is ripping higher, which you pointed out was perhaps, if that were to happen, a risk for the market. What's happening now, I guess, with the oil thing, and how's that impacting stuff?
So, more specifically, we had OPEC and OPEC Plus agree to a surprise cut of about 1.5 million barrels per day.
Is that a lot?
That is decently chunky.
Okay.
The U.S., for context, consumes about 20 million barrels per day. So it's a lot. But remember, with commodities and with any market in general, it's a market set at the margin.
Yeah.
Right. So if you take 1.5 million barrels per day off, the market, right, it's definitely going to apply upward pressure to prices. In addition, some of the research we've read suggests that OPEC has more pricing power than ever, as in the marginal supply is more relevant than it has been from OPEC and OPEC Plus. So, I think the market is correct in sort of pushing crude prices higher. And we went from about $75 a barrel for WTI crude to about $81 a barrel. That's been a pretty significant move. And through $82 a barrel, there's a pretty strong resistance there that we've kind of been at for the past 3 to 4 months. So if we move through these levels, it kind of suggests you're going to be headed towards $90 or even $100 a barrel. Most of the street has moved up their year-end forecast for oil. We're in the camp of I think in the back half of this year, you're probably going to see oil prices closer to $100 a barrel. Partially a function of OPEC and OPEC Plus, being very strong-handed in terms of supply cuts, but it's also a function of dollar weakening. Today we've had a pretty, meaningful weakening of the dollar versus gold, but also versus other currencies. And I think that speaks to what we've had recently in terms of data. And what we've had in terms of the data is a meaningful continuation of the deterioration that we've seen.
Right.
So ISM manufacturing yesterday was incredibly weak. The prices paid component was really weak, which is inflation. The employment section was really weak. And then today we got job openings that dropped by a lot, durable goods that didn't look good. So even though oil has moved higher, and that is sort of has a very strong feedback loop into inflation. The hard data we've seen and the soft data we've seen from manufacturing and the real economy in the U.S. is suggesting quite the opposite, which is a slowdown in pressures.
I see.
And some of the other things I've seen, like credit card spending data for March is like down meaningfully month over month. So things of that nature point to like a cool down in the U.S. economy. But again, energy has such a strong feedback loop into like literally every good and service,
Right.
that it's a risk that people need to be aware of. And one of the ways, here at Galaxy, we think about it, you can look at like option structures on crude or energy markets and stuff. And so I definitely think that it should be in the average investor's, kind of toolkit, because that is a huge kind of like tail scenario for the market and for the disinflation story.
Yeah, it's interesting when you think about the cooling down should be good for the risk assets because it could mean the Fed's doing its job and they don't have to hike as much, and then we can finally take the foot off the gas on rates. But if energy is getting much more expensive, or if other commodities eventually do, right? The China reopening is still happening, right?
Yeah, no, absolutely.
Then that has a pretty inflationary impact long term, and it's awful because it's one of the things the Fed really can't impact very much, right? So they have to, if inflation overall stays high or goes higher, even while the economy is cooling, but the thing causing it is something the Fed barely can affect. We're still in that rock and hard place scenario.
Oh, absolutely. I would hate to be a central banker right now. But again, they are, there's no good outcome here.
Yeah.
And so I'm just kind of taking my cues from the markets, and what the markets are telling you is that, while there are upside risks to oil and stuff, like it didn't go to 100 after the surprise cut.
True.
And rates have been moving lower, and the market is pricing in cuts.
I saw this.
And the dollar is weakening, and risk assets are rallying, right? And so it speaks to kind of, what we talked about last week on the podcast, which is the right tail of interest rate policy risk is kind of being removed from the market, right? Even if oil prices were to get, much higher, I think folks realize that, central bankers understand the limitations of monetary policy and aren't going to pursue that crazy 6-7% interest rate policy if, all of a sudden, bananas start to go through the moon.
And there are other things, right? I mean, if oil and gas go higher, I know we're really talking about oil and not gas, but if energy goes higher, right, then things like the U.S. fracking complex maybe comes back online and can sort of.
It takes time.
I know it does. But
Yeah. No, you're right.
But there are other policy decisions that theoretically can be made in the U.S. to put it to sort of help out on the oil front. You can literally allow more drilling, for example. I know again, this administration's not very keen on that, but if it got really bad, there are other tools other than interest rates to push back on that too. So very interesting. So the like you said, risk assets are rallying. I saw S&P's through 4,100, which I'm not an expert on this, but on TV, that's what they've been talking about as a key level on CNBC for literally weeks and weeks and weeks.
Yeah.
Is like what the sort of average, near-term bull has been targeting as the bullish level, and we're through that.
And NASDAQ's also, outperforming a lot. I mean, you're up almost, I think like 17-18% on the year.
Right.
But, one of the key things that, I think is worth pointing out is you're entering a period of very strong seasonality.
I was just about to say this. April alone as a specific month is a very bullish month.
Very bullish month. Like 80% hit rate of being bullish. One of the highest months on average.
Which is wild.
And then if you look at historical returns based on years where, S&P had a good start to Q1, odds are you're going to have a great rest of the year.
There's only a couple years where it was up
actually less than it was then.
I was going to say there wasn't even. Are there even any years where it's down for the year? I saw there was some.
No.
There was 1 year in the last 30 where it was up a lot in Q1, but then barely eked out
1 extra percent.
Yeah,
I think that
plus,
was 1987 or something where it was up 7%, then it closed the year up 8 or so. Something along those lines. But long story short, there's been about 25 times when S&P's been up more than 7% in Q1, and basically 23 of those 25, you ended up having a great rest of the year.
Crazy.
So there's some good data to support.
Yeah, I mean that's the kind of stuff. It's sort of a historical guidance concept, but it's not prescriptive at all. Anything can happen. We're in crazy times.
No, absolutely.
But still, I mean, it's such a weird time here. Yeah.
And then the other thing to think about is just like, although there's feels like there's a lot of uncertainty in the world still,
Yeah.
right? The actual uncertainty priced in by the markets has actually come off a lot.
Interesting.
And that's actually generally risk positive, right? So when we had that whole banking crisis, interest rate vol shot up, and twos are moving 25 basis points up and down like crazy. And now it's like a little bit more gradual. I mean, today's a little bit of an aberration given, the data print we've had. But the interest rate vol has come off a little bit. Liquidity has entered the market. The VIX is, on an 18 handle now. We spiked through 30 during that crisis. And generally speaking, like it's been a little bit calmer, and I think the Fed is more in a position where it's kind of wait and see, right? They don't want to really cut rates throughout the balance. They just kind of want to wait and see. They'll go one more meeting most likely, and then just wait and see. So there's a lot less uncertainty in the market, I think.
And they got rates up high.
Pretty high enough.
Like they did a lot of hiking.
Reasonably high.
We're not at the beginning of the hiking cycle.
Correct.
Yeah.
And so, one of the ways I think about my equation mentally, at least for the market, is like the more uncertainty there is, the lower the prices, generally speaking. And so right now we're adding less uncertainty into the market, and people are more comfortable.
We're adding more certainty.
Correct. And it's also just a function of like a $10 million position on a 20 vol is very different than a $10 million position on a 40 vol. Right. And so naturally, as vol comes down, you have room to add to notionally to your position, because your risk unit is actually staying constant as your notional. And so as vol comes down, people can take more risk. And I think that's what you're kind of seeing, with things like S&P, NASDAQ, and a little bit of crypto.
What do you see? Yeah, I was going to say, how does this play into crypto? Let me set the stage here. I just saw that ETH BTC is back up a little bit. I mean, it's what, like 0.064-ish?
That's 5, I think,
0.065.
Yeah.
And it had gotten down to like 0.062-ish.
Yeah. I mean...
So ETH has been outperforming just the last few days. Bitcoin, I think year to date still outperforming, but ETH. But, is that part of this? It's sort of like, well, we're in a little bit of a, more risk on mentality right now. The street is feeling a little bit more comfortable, and ETH is seen as a little bit more risky. It certainly is higher vol than Bitcoin. Is that part of the story?
So I think it's the ETH BTC story, to me, is just positioning.
Yeah.
Right? People, got very bulled up on Bitcoin after, the banking crisis, fiat debasement, banking insecurity, etc.
Chancellor on the brink of second bailout for banks.
Correct.
That whole story.
And then, gold was ripping as well. And so, it had a really strong narrative, positive narrative. And, ETH with Shanghai upgrade coming up.
A little bit of uncertainty.
A little bit of uncertainty. And so what did you have? You have people positioned for that. And so ETH BTC moved a lot lower, right? As, Bitcoin had its huge leg higher. And then you're left in a situation where everybody's kind of like max long Bitcoin and max underweight ETH. And that's where we were like 2 days ago.
Yeah.
And then people are like, wait, ETH has been trying to break through like 1820 like 7 times now.
Yeah.
And like it broke through that level, today, and you had a subsequent rally in ETH BTC. I think the high has been like 1880
I think it's the highest, certainly highest year to date for ETH.
Since merge. Merge we got to like almost 1900 and change.
In September.
Yeah. And so I think what you've seen over the past like 2 days is just a positioning unwind where people got a little overextended on Bitcoin and a little underexposed to ETH. And you just had that unwind happening.
Yeah.
I think fundamentally, like, I still prefer being long Bitcoin, but there's no issue being long both right now.
Yep.
And I continue to think that one of the best ways to express it is upside options. I think people really underestimate kind of how violent moves to the upside can be, especially when you take out technical levels. If you think about it, we went from 20 to 28K in the span of 2 weeks, right? That's a huge move.
Yeah.
Right? That's a 40% move.
Yeah.
Like that can happen in 2 weeks.
Yeah.
Right. And so, 1 month implied vol at like 60 doesn't really make that much sense in this kind of a market. And so I still think that the best way to play for crypto upside is probably in optionality. But being long also. Long and strong.
Yeah, well, it's a fascinating time. I'm excited to just keep following this. I can't.
Absolutely.
I mean, it's a much more interesting time in my mind now than it was, like, say, last summer. Remember, we had that episode with you and Robert Bakoki and Christine Kim. I think maybe like June of 22, and we were sort of max bearish. I mean,
It
I
was
think
like
that
18, 19K Bitcoin,
Yeah,
and then we went to like 16.5.
I know this is this famous, in my mind, famous episode where we asked everyone to say a positive thing, and you were just like straight up stumped, couldn't come up with anything. And yeah, that was an interesting time, but I just the complexities swirling around in this market now are so interesting. The geopolitical stuff happening with China's reopening, but also China making all these moves on the world stage. Finland just formally entered NATO like this morning. Which is literally an adjacent country, adds a dramatic amount of border with Russia to NATO. There's just a bunch of stuff happening. Even Mexico's foreign minister last week said that that their vision was aligned with the BRICS countries. They're interested in doing more with BRICS. I'm like, that's our southern neighbor, right? I mean, there's a whole you got the debt ceiling.
Have you heard of NAFTA, guys?
We're going to talk with Tyler Williams. I know NAFTA. We're going to talk with Tyler Williams in a bit about the debt ceiling debate, which still has to happen in the U.S. Probably get solved.
That's
I mean, there's a lot of moving pieces that makes it an
absolutely.
exciting time. So I'm looking forward to keep talking with you about it. But that's it for today. Beimnet Abebe from Galaxy Trading, our good friend. Thank you so much.
Pleasure. Thank you for having me.
Let's go now to our guest, Tyler Williams, Regulatory Affairs Counsel, Head of Public Policy at Galaxy Digital. Tyler, our friend, good to see you again.
Good to see you, Alex. Thanks for having me back. New year, new beginning, new time on Galaxy Brains.
We're already in the second quarter. The last time we had you on Galaxy Brains, I believe it was the week that FTX blew up. So quite a while ago. A lot has changed. I guess just before we even get into all that, I'm in New York, you're in Washington. I think about 8 blocks from us in Lower Manhattan, former President Donald Trump is being indicted as I speak. It is Tuesday. April 4th. Tuesday, April 4th, and there are helicopters overhead here in New York. It's a little bit of a scene. What is the mood there in Washington and on this Trump indictment?
So honestly, Congress is out. Both the House and the Senate are not in session. So that definitely colors and affects the general mood in Washington. Like, the town is just slower when members aren't here. So I haven't seen any sort of protracted outcry in Washington that we have seen on the news and otherwise in Lower Manhattan. So I think it's drastically different, but we're in uncharted, new history, right? Like, we haven't seen this in terms of indicting a former president or a sitting president in quite some time. I think there's maybe one previous example in history, but I don't know the facts and circumstances of that, so I won't recount all of them.
Yeah, and I think the example, I'm willing to be wrong on this, but maybe was it like Teddy Roosevelt supposedly got like a speeding ticket or something? That's the story I heard. I don't know if it's true, but that's the level of discrepancy we're talking about versus what the former President Trump is facing.
Yeah, I think that's right. That's what memory serves me, but I wasn't 100% sure either. But we are in a new world order, I guess.
I mean, President Nixon was certainly in legal jeopardy, but he was pardoned.
Right.
And I don't know, maybe back in the and challenging people to a duel days, there was something here or there that could have happened. I don't know. Yeah, it's pretty wild.
Sure. I think we settled our legal scores in different mechanisms 150 years ago than we do today.
Yeah, as they say in Hamilton the musical, everything's legal in New Jersey. Look, let's move into the real reason we're talking. How has Washington changed? We talked in early November of 2022. It was right after the congressional elections, the midterm elections. I think when we spoke, they hadn't even actually finalized that Republicans had won the House. Of course, they did eventually win by a narrow margin. They're now in control of the House. But it's been, almost 5 months since we spoke, and a lot has happened. Broadly speaking, how does Washington feel different since it did than it did back then?
I think it feels quite different. I think that the FTX debacle and blowup has definitely colored the crypto economy in Washington. That is for sure a true statement. I think in addition to that, what we've seen is other issues in the financial services sector and in our economy have started to creep up. And that too has colored Washington. So if you think of Congress is generally a reactive body, they try to solve problems that are like emergency or exigent, and sometimes they do a good job about planning for the future. But usually it's like dedicated in spending, it's dedicated in very specific areas. And here, what we have seen is the banking issues that have occurred with SVB and Silvergate and Signature. That has caused at least the financial services policy community to sort of turn their attention a little bit more to issues affecting the traditional banking sector and perhaps the commercial real estate market as well, which gets into like a broader macro topic about interest rate policy and like our general spending environment. So I think it has shifted policymakers and legislators' opinions, or maybe not opinions, has shifted their focus a little bit. But that shouldn't miss the underlying current. There's still a lot of people who are working on digital asset policy in both the House and the Senate, and then also in the administration. So there's still people working on it.
So how is the banking crisis really? I guess it's now 3-4 weeks, maybe 4 weeks since SVB was taken over ish, and there was, I guess sort of how is that simmered? Now they're on break. Are we likely to see any legislative changes? I know there's oversight that's been happening, and some hearings have already occurred where the FDIC was in Washington, the chairman, and certainly Jay Powell did his semi-annual appearance where he was actually that was right before it. What is the mood? I mean, what are people blaming for it, or what do you think comes out of it from a legislative perspective?
Well, as this shouldn't shock anyone or any listener, but Washington's very good at pointing fingers at each other. So we had the crisis in 2008, and then in the immediate aftermath, we had Dodd-Frank, and Dodd-Frank was billed as an end to too big to fail. And it was going to ensure that institutions who were in troubled financial situation, they had a path to resolving that financial stress in an orderly manner, and it wasn't going to cost taxpayers. That's literally in like the beginning of Dodd-Frank. And so now we're here today, and in 2018 there was some legislative effort, and people commonly refer to this as S2155, which was largely billed as fixing sort of the regulatory overreach and impact of Dodd-Frank to community banks, mid-sized banks, and sort of like the super regionals, I'll call it. The banks that are above like 100 billion, below 250 billion in assets. And so what we had was that bill had broad bipartisan support in both the House and the Senate and was signed into law. And there are some folks in Washington that are pointing to that bill as sort of the reason that SVB went down. And what we've seen in that is like a little bit of finger pointing. I would say there's close to a 0% chance that we see legislative movement to restore or strip that bill, or to remove the authority from the Fed for tailoring in different size institutions. But what I think we will see is the Fed, and particularly the Vice Chair of Supervision, Michael Barr, use his existing authority under the legislation to ensure that the larger institutions on that scale, that the regulators and supervisors have more tools available to them, and perhaps tailored tools that are available to them. So I think we'll see the regulators take sort of a new, fresh look at the legislation.
Yeah, that's a question, because I know some on the left in particular have blamed that. They've called that 2018 reform S2155 a watering down of Dodd-Frank. And I guess this is, please correct me, my understanding, the reason they say that is that it raised the threshold that banks would be SIFIs, considered SIFIs, right? So it's thus sort of exempting some, like you said, super regional, big banks, but not big enough, from additional oversight.
I would say it gave the Fed additional tools to tailor their supervisory and regulatory regime within certain size parameters, so that those banks that were larger than 150 now the regulators had new supervisory tools to look at them and put them into different categories for capital and liquidity.
Rather than, prescribing it sort of top down from Congress.
Yeah, yes, that's
A little
exactly
bit more
right. That's
leeway.
exactly right.
But a big the banks are holding a lot of debt. A lot of them are from right before interest rates started to dramatically rise, right? And some of those are hold to maturity that don't really get fully exposed on the balance sheet. But more broadly, isn't this a problem the Fed like definitely was well aware of? Like, aren't they aware whether you're a $50 billion bank, Fed member bank, or $150 billion? Aren't they aware of what you have on your balance sheet? Like, shouldn't this? To what extent is this foreseeable? Like, just in general, from the supervisory side of the Fed?
It seems to me highly foreseeable, and the Fed and the reserve banks and the bank regulatory system, like they all have different dedicated supervisory and exam teams that are specifically focused on different size institutions. And so you'll have like large bank groups, you'll have community bank groups, and you'll have mid-sized groups at almost every one of the banking regulators. And each one of their jobs is to ensure that like the safety and soundness of the banking system isn't compromised. So there's literally like probably thousands of employees across like the federal banking regulators that their sole focus is supposed to be the safety and soundness of the banking system.
Yeah, and it just seems to me that, and of course they've come out since they did the BTFP and sort of other backstopping measures, and we did only see so far SVB and Signature. I'm not even going to include Silvergate in this because I mean they certainly. It's a little bit more nuanced there, and they weren't taken over, right? They just closed shop, and then First Republic sort of allowed to limp on, and then eventually Credit Suisse abroad. But like they've been coming out saying the banking system is safe and sound, but obviously now it's very clear that it's really on relatively tentative footing, absent the unlimited backstop that ultimately the Fed can provide. Right. I mean, there's a lot of banks whose balance sheets look pretty weak. Right. And so it's just not clear. I'm having a hard time understanding this. I understand how Fed policy, they can't come out and say, by the way, things are looking shaky. Right. Because the second they say that, things will collapse. Right. I mean, they have to sort of always project confidence. But like it just seems to me that this is a very foreseeable problem that everyone was so shocked by.
I don't disagree that it was a foreseeable problem. And my comment earlier about the commercial real estate,
yeah,
if we see a weakening in the commercial real estate market, like that could bleed into like a broader swath of the banking system. Because if you look at the balance sheets of like community banks all across America, they all hold a significant amount of commercial real estate exposure on their balance sheet. Like, true, it's very dedicated and localized in different banks. And so like, unique risks might not sort of present across the entire system, but it might be another weak spot, particularly if we see like a continual rising rate environment and we start to see like defaults actually tick up.
I did see.
We haven't seen that. What I was going to say is we haven't seen that today like we saw in the run up to the 2008 crisis. But I don't disagree at all with you what you said. Like the policy is a little confusing because in 2008 we said we have a crisis. We had a mortgage crisis that led into significant sort of wholesale banking system reforms. And then we purported to end too big to fail. And now we have the banking crisis that exists in like the SVB in the last couple months. And now we have a situation where like I'm not entirely sure what the projected policy is, other than we certainly didn't end too big to fail. We just said we're going to reignite all of the emergency liquidity provisioning tools that our banking regulators have, and on a very spot basis. I think that's the policy now.
That's what it seems like. All right, let's move on a little bit because the banking thing it's just a wild thing. I joke that like banks are like it's like magic, right? Like you just if I run a central bank or a bank, I mean in general, like you just like you have to say it's fine the entire way down, right? It's like no matter where it is, you can never.
We could have an entire session dedicated just to this.
Yeah, exactly. But exactly. So let's move on. Let's talk a little bit about the crypto and banking stuff. Really, I want to actually just focus on Signature in particular. We've talked, I think, and certainly from my platform at Galaxy Research, we've written a lot about Silvergate and Signature, and the banking crisis from a crypto standpoint. But even just earlier this week, I think yesterday or Sunday, in Barron's, Barney Frank, the of Dodd-Frank, right, former chairman of House Financial Services during the Great Financial Crisis of 2008, and named co-sponsor of Dodd-Frank. He was a director on the board of Signature Bank, and he said right after it was seized by NYDFS and given to the FDIC, and he continues to say that he believes that it was targeted because of its crypto activities. He believes it was solvent. What do you make of these comments? Certainly, I'm sympathetic to this because it seems as if it was seized right before the backstop was announced, literally minutes before, right? And First Republic has sort of been allowed to limp on when it looks quite impaired, but Signature was not. And the NYDFS has said expressly that it wasn't. The reason that NYDFS says it was seized was because of a crisis of confidence in the bank's leadership as it relates to its reporting. That's literally what the superintendent Harris of the NYDFS, its primary regulator, said about Signature. But Barney Frank, a director there, says they believed it was solvent and it could have opened on that Monday. And he said just this past Sunday that he believes crypto was targeted. What are your thoughts on this?
I wouldn't be shocked at all if it was targeted for those specific reasons. I haven't examined the balance sheet to know whether or not the financial distress of the company wasn't the but for cause of the receivership.
Yeah.
However, as you noted, we've talked and written about in the research the successive actions that have transpired just in this calendar year, starting from January 3rd, where there was the joint statement plus the joint statement from the prudential banking regulators, plus the custodial decision and so forth and so on.
Mm-hmm.
And I think what we have seen, and the only thing that we didn't cover within that research was there was a FDIC IG report that explicitly stated that there were 136 banks in the United States that were interested in or providing services to the crypto economy. And if you think about that in the broad scale of the banking system, I don't know what the exact number is today, but we have close to 5,000 FDIC insured banks in the US. So it's a subfraction of a fraction of a percentage point of the banking system,
right,
that is providing services to the sector. And then we've seen these successive actions plus the receiverships and of one of the main sort of financial conduits and the on-ramps to the digital asset economy being taken into receivership. And then if you look at the after effects of that, we saw the sale of the non-crypto related deposits to Flagstar.
Yep.
And the crypto deposits sitting around in the bridge bank. Reasonably people can disagree about, the facts and circumstances of that, but I think it's hard to disagree with the outcome. And the outcome certainly looks like the federal government is saying we don't want the banking system provide services to crypto.
Yeah, it's a tough situation. And this, along with some of the market regulators' actions, really goes in the opposite direction of what some of the other major world economies are doing. We've talked about this. We talked about this on our podcast with Tim Grant earlier this year. But if you look at the UK, Europe, Japan, Hong Kong, Australia, parts of the Middle East, right? Again, major economies, right? They're really going in the opposite direction here, it looks like. Not just not doing an Operation Choke Point, but in some cases being, putting forth and enacting extremely progressive regulations. MiCA and the EU, the recommendations from His Majesty's Treasury to the FCA in the UK, and I just can't help but note that stark difference. It's something just as an American, I'm particularly hopeful we can move past and sort of figure out a way to get over these very restrictive and even I'll say, dare I say, negative policy decisions that seem to be being made in the U.S. On that point, Tyler, I've been following the House Financial Services Committee for a long time. What does it look like now? We have Representative Patrick McHenry of the great state of North Carolina is the chairman of the House Financial Services Committee. I guess Democrat Representative Maxine Waters now is the ranking member. They've worked together in the past. They worked last summer a bit on that stablecoin bill that was widely reported. You've got Representative French Hill now sort of in charge of a subcommittee on that on the House Financial Services Committee that's focused on digital assets. What's the mood look like at House Financial Services? Do we feel positive about anything getting done on a bipartisan basis this year that could be positive for the crypto industry?
Yeah, absolutely. And just to tie one ribbon around like the banking issue, I even think there's like a positive narrative within Congress relative to the banking issues, because we have seen some pretty strong oversight from both the Senate Banking Committee and the House Financial Services Committee relative to these debanking efforts. And we've seen it in the past couple of weeks. There were multiple hearings in both the House and the Senate with the chair of the FDIC, with the vice chair of supervision from the Fed, and also with the Treasury Department, all relative to these issues. And we saw like specific commentary. So I think we'll continue to see like people, policymakers, particularly legislators, pushing back against like the debanking.
Great.
Relative to like the progressive actions that might happen, or like the bipartisan work that's happening in the House Financial Services Committee, I think it's entirely true that both Chair McHenry and Ranking Member Waters are trying to sort of build the momentum around producing both a stablecoin bill and then a market structure package. And I see that because they are pulling together these bipartisan briefings. So they're trying to do everything together. So they're having briefings from experts coming in and talking about stablecoin policy. They're having briefings from experts coming in and talking about market structure issues. And they're also doing it in concert with the Ag Committee. And I think that's really important because there's this historic jurisdictional divide between securities and commodities, being like the Ag Committee and the House Financial Services Committee. And I think what Chair McHenry and Ranking Member Waters are trying to do is like build a collegial environment and do briefings together. And then it looks like they're going to release at some point in time these two different legislative packages and try to move them through their committees with like a dual referral process, which is, Washington, D.C. parlance for like, they're going to try to do it together and they're going to try to produce a piece of legislation out of the House that has bipartisan support, which I think is a very strong signal to people in our space who care about policy and regulation.
Yeah, that's great. I didn't realize that the sort of bipartisan spirit that Representative McHenry and Representative Waters, we know they had last summer, has really sort of persisted so dramatically. That's great. Not just between the two parties, like you said, but between the financial services and the agricultural committees. That would be ideal, right? I mean, I think that's great to hear. Is this the one issue in Congress where we're seeing this? I guess in China, hating on China are the two main bipartisan issues right now.
Washington finds strange bedfellows. So those are definitely two bipartisan issues. There's lots of other stuff going on in Washington. I'm not saying this is like the only important issue. We obviously have like the debt ceiling debacle of whatever might happen there.
Yeah, what is the current state on the debt ceiling? Right, the Secretary of the Treasury Secretary Janet Yellen is currently using emergency measures to fund the government because we're actually out of money at the moment.
That's right, and
they always
Speaker
solve
McCarthy,
this, right? They've never not solved this.
They've never not solved it, but we've come close to not solving it a couple times. And if you remember back in 2011, like the last time that this was like a serious emergency debate, when Speaker Boehner was around, he was negotiating with President Obama at the time. And we had sort of like that near default, but we did have a slight downgrade, if memory is serving me correctly. Mm-hmm. So we've come close before. Now is a question of, it's pretty much the exact same political divide. You have Republicans controlling the House, you have Democrats controlling the Senate, and a Democratic elected president in the White House. So it's the same dynamics as 2011. I think the only difference is like we have a really different conference in the House from a Republican majority, and we have a much thinner majority in the House than we did in 2011.
Right. So you had a more, I think it's fair to say, a more moderate Republican conference in the House in 2011, but a bigger one. Whereas you have, is that fair?
I don't know. I wouldn't say we had a more moderate. I would say there was a larger majority that Speaker Boehner at the time enjoyed, and there was still this. The conference was still divided insofar as there was less collegiality around sort of the underlying conference. Like there was less unity in that conference, and so it allowed the speaker to exert a little bit more authority and agency when he was negotiating with the White House. What I think we have now is perhaps more collegiality. It's just in a starker, more hardline position.
Got it.
So I don't know exactly how to handicap it, other than I think everyone understands that like a downgrade and a default on like the U.S. debt would be a cataclysmic event in like the world's financial markets.
Yeah, it would, and not just in the financial markets, but I think in terms of monetary history, I've been following a lot. I don't want to be a doomer on this. There's a lot of people on Twitter that are sort of dollar doomers at the moment, and I'm not one, but I would say I think that there's been a lot of de-dollarization progress, if we want to call it that, worldwide. When I look at 2023 versus 2011, the Saudis have really started to chart a third way here. They're not really, we talked about this with Beimnet earlier, but they've basically orchestrated an OPEC supply production cut against the wishes of the White House, which is pretty rare historically in the long, allyship between Saudi Arabia and the United States. You see Saudi agreeing to sell, their oil, the oil that they sell to China, priced it in the yuan, which is about 25% of all Saudi oil exports. On and on. There's a whole bunch of examples of this. China, people didn't even talk about this. China just negotiated essentially a peace deal between Iran and Saudi Arabia, and the U.S. statement was, "Oh well, the Saudis kept us in the loop on this, and we're just happy that something got done." AKA, like, wow, like we had nothing to do with this, and we're basically totally unimportant now in Saudi-Iranian relations. So my only point is, I think it would actually be much more cataclysmic, even a slight downgrade this time, because we are in a much more multipolar world now than we were in 2011. So let's get it together, people in Washington. Let's get that debt. We should also reduce the debt, but let's also not default on it.
Yeah, these are expenditures already incurred, so to speak, right? So we're just like
paying our credit card bill.
Bills we already owe.
Yeah. Tyler, just one last question overall. You talked about market structure legislation and a stablecoin bill. When you talk to people about crypto now, I've gone through a lot of eras in the sort of blockchain timeline, right? And I joke that the period in sort of 2012 to 2015 or so was the blockchain, not Bitcoin, right? Every single big bank and big company was like looking into blockchain technology. But if you ask them about Bitcoin, they'd be like, "Oh no, Bitcoin, that's for criminals," like because of the Silk Road and whatnot. We had Chris Tarbell on last week, who took down the Silk Road. But that blockchain technology, baby, that underlying tech, it's still nice, right? We can do stuff with it. Are we back in that era? Is that what people are asking about now in Washington? They're upset about the crypto markets but they still think there's this big blockchain opportunity outside of crypto.
I think that's generally right. I would just put us more in like the world of like people want to show us the use case. And as I mentioned, like in Washington, especially in Congress, it's a very reactive body, and people need to be able to see and feel like whatever change is occurring. And we need to be able to produce sort of like the tangible, physical, real world, like, let me play with this toy type thing.
Yeah.
And I think the momentum, at least in the policy environment, isn't gone. I just think there are other things that are sliding in as well. And if you think about like AI and the revolution,
are they worried about AI?
I think people look at ChatGPT as like the real world use case for AI.
Yeah.
And they say like, here's this cool tool. I can throw in any question and like the magic computers give me this answer. And I don't know how the computers are working, but I have this answer. That's their use case.
Yeah. Yeah, I think it's so funny when you bring this up to me, because like I look at non-sovereign decentralized money in a multipolar world. I look at something like being your own bank or decentralized finance in a world where, gosh, banks and finance look pretty dicey, dicier than I think they have in a long time. Those seem like powerful use cases to me, but I guess those aren't the ones that a lot of Washington wants to hear about, right? They want the dollar. They don't want decentralized money. They want the dollar. What did President Trump say when he was president? That I don't like Bitcoin. It's not money. Like, I like the dollar, right? I mean, is that part of the issue? They're hunting for some other use case than what I think. I mean, even digital collectibles. I mean, sure, a huge bubble happened in the NFT space, but there's going to be those digital. You're asking for tangible use cases. My Twitter handle is intangible coins, right? Like, is that not compelling? Should I change it to tangible uses instead of intangible coins?
Maybe you should change. I don't know. I hear you. And, as I think about it, like, we're kind of in a policy debate for the future of like the global capital markets.
We are.
And in some ways, we don't know exactly what is going to happen. But we know that like the future in like 50 years or 100 years is highly unlikely to look like it does today. And so if someone suggests like a use case might be like tokenizing securities, right? But like, unless we have the ability to actually do that, and unless we have the ability to like actually conceive of that and consume it from like a retail investor perspective, it's very hard to convince policymakers, because what they need is like, show me things that I can tell my constituents that I'm working on. And if my constituents on the largesse don't care about these things, how am I supposed to care about it?
Yeah, I get that. Well, I think the last survey I saw, I forget who produced this, but 20% of Americans own crypto as of the end of 2022. So hopefully that's a lot of constituents. Hey, Tyler Williams, Galaxy's head of public policy and regulatory affairs. As always, my friend, thank you so much for joining, and we'll check in with you in a few months, and we'll see where the party is then. Maybe around the debt ceiling in the summer.
Sounds great. I look forward to it. Thanks for having me.
Thanks, Tyler. That's it for Galaxy Brains this week. Thank you to our guest, Tyler Williams, and Beimnet Abebe, as always. It's really an interesting time in markets, so I'm really happy that we get to share it with you every week. And so we will see you next week. Have a great weekend. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.